You've talked a lot about late cycle bond rallies before. Can you dive into this a bit? And given, do you see this latest rally as sustainable? We just had the latest B of A managers survey that came out that showed investors were dumping cash and hold the biggest overweight position in bonds since 2009. So what are your thoughts on the bond market right now?
Well, I think the biggest picture thought, and I when bonds hit in the ballpark of 5%, and there were some people drawing lines to 13%. I said, hold on a minute, you gotta understand the bond market at 4.5 or 5%. The composition is very different than the composition when it was at 2%, right? And what that means is that there's a lot of yield sensitive buyers that emerge in that as you start to elevate the interest rates. And that's literally what we've seen is even though the deficit's up, yield sensitive buyers have picked up. And that Bank of America survey is a good example, right, of yield sensitive buyers shifting their positions in response to the price changes that have occurred. And so that's kept a lid on things. I think basically what we've seen is that there's been not only did we sort of get to that point, but then on top of it, essentially Janet Yellen decided to do an easing step, which is, politically advantageous, probably macroeconomically stupid, but politically advantageous. And the reality is that she could keep doing it. I mean, in fact, Janet Yellen in the next QRA could cut bond as she cut coupon issuance. Slow coupon issuance meaningfully, and still coupon, bills would be under 30% of the overall debt profile of the U.S. And 30% isn't even all that high if you go back through all history and stuff like that. It's been well above 30%, and so in history. And so, look, could Janet Yellen keep a lid on this bond market by continuing to ease to limit coupon supply and duration supply and keep the low end, long end of the bond market contained? Absolutely she could. I mean, certainly for any time frame that we care about as traders. The consequence is just that if she does that, the Fed's going to have to do more because, by keeping in a late cycle, a later cycle environment, an expansionary environment, if your response to an expansionary environment is to lower interest rates on the long end and stimulate equity strength, the outcomes of that are going to be such that you're not going to achieve your mandate for inflation, right? Growth will be too strong relative to your mandate for inflation. So that's probably, I think that's certainly a plausible dynamic that we can see, which is why those December 24 SOFRs are crazy in that context, which is if you're going to have, you're not going to have a circumstance where there's a strong economy. I mean, I would argue, unless the economy is terribly weak, the Fed is not going to cut in the way that's being priced in. And certainly if it's stronger than people expect, even if it's moderately good, supported by all these easing steps that have occurred, there's no way the Fed's turning around and cutting. I mean, in March, Fed's going to cut in March? No way. Not going to happen.